All right, today we want to look at the actual risk to reward graphs. So, a risk to reward graph is a visual representation of when and where our option strategies make or lose money. So, they say that we actually learn by hearing, seeing, doing, writing, reading, so many different ways. And so, what we want to do is actually give us a visual representation so that way we can physically see when the stock goes up or goes down, how much are we making or losing based off of what the actual stock is doing. And so, um, another benefit of the risk reward graph is that you can actually understand how you can benefit from a non directional movement of its stock. So, we've talked about buying calls and buying puts, and so we actually need the stock to move. And I said in one of our very first videos that you can make complex strategies. And so one thing you can actually do is make a strategy where if the stock literally doesn't move, the stock is at $30 and it stays at $30 for the next 30 days, which we know is theoretically impossible, it would move. But if that happened, you would actually benefit or make money from that stock literally doing that. So let's dive into this. It's going to help us to make sense of what you've learned so far and to try and piece it all together. And so what we have is an example of a long call. And so when you're looking at a long call, what you need to recognize is that over here is basically your profit and loss, right? If it goes up or down, how much you're going to make. You see, we have the positive side and the negative side. So this is when you're going to be losing money. This is going to be when you are making money. Okay, so we want to recognize that. And so if you look at this, right here, you can see that you have started off because it's a long call, it was a debit. In other words, they took money out of your account, and so you paid money. And then you can see this graph has a zero line. Now, this right here is the actual price of the stock. If it goes from 0 to 100. Now, the stock could be any price. It could be, a $500 stock. It could be a $10 stock that's going from 10 to 20. But I just wanted to kind of give you a representation so you can actually recognize this. And so when you first purchase a long call, you start off in the negative in the sense that because you are purchasing something, you are spending money. And because what we're looking at is based off of expiration, when the contract expires, you need the stock to move in your favor in order for you actually to make money. And so this is what we call the strategy P&L. And so we're looking at how does this strategy, the long call, this graph, how do we make money? And so what we're seeing is that as the stock goes up in price, this is how this one actually makes money. Okay. And so, um, hmm. And so a long call strategy is a bullish position. It is a position that we expect the stock to go higher. Okay. And so now let's look at the complete opposite, which would be a short call. Now, a short call is when you actually sell a call. Remember, we talked about you can buy or you can sell calls. And so if you look at this one, you can see that you have a max profit. The most you can make is this. You see how it's a flat line? That's because that's the most you can make. Whereas if you go back to this one, the profit was theoretically unlimited. It could keep going if the price of the stock continues to go higher. Okay. And so what we want to look at is even with this one, you have a max profit, and you also have a break even. So because it's a long call, if you remember we talked about this, when you are selling a call, you expect the stock price to go down. And so if the stock price goes up, that is where you start losing money as the stock price gets higher and higher. And so you actually have a max profit on this, which you can see, but you have unlimited risk. You have unlimited risk. And so theoretically, because the stock can keep going. And so I hope that this graph is really helping you to see how the movement of the stock actually tells us our losses or our gains for this particular option or this particular strategy that we are actually running. So a few other different strategies that we have what's called a short put. Now, a short put is, once again, when you sell a put, you're short the put. And so you have a max profit also on this one because, once again, you sold to open. Remember, we talked about all these different acronyms. We had STO, which is sell to open. And so you have a sell to open. And so if you look at this graph, what you're seeing is that as the stock goes down, you actually lose money. And your max loss is actually wherever the stock is to zero. So let's say the stock was at $50 and the stock went from 50 down to zero. Then theoretically, your max loss is capped at the zero line of that stock. But your max profit is also capped at what you sold it for. So if you sold it for $2, let's just say, which would be $200, then that is the max profit that you can make. And so once again, you have a break even line right here, you'll see. And so that's as the stock. So as the stock goes up in price, you'll see that you are making money. As the stock goes down in price, you are losing money because you have a short put. So I hope if you went back and watched all the lessons that this is making sense, which direction we expect. So a short put, we expect the stock to go higher. And with a short call, we expect the stock to go lower. And so now what if we do? We take this and we actually combine. So now we're getting a little bit more technical. And so we actually bought to open a long call. And so that long call makes money as stock goes up. But then what we did is we actually sold to open a short call, right? So that, remember, if you go back, you'll see the short call loses money as the stock goes up in price. Remember, it's starting to lose money. And so what you are doing is you're actually capping your profit. And so now this might be a great strategy for somebody who is risk adverse, because as the stock goes up, you have a max loss. As you can see, it's a flat line, but you also have a max profit because you sold up here. So this could be a great strategy for somebody who is risk adverse and wants to know, hey, the most I can make, the most I can lose. We all obviously want unlimited potential as far as profit, but there is a give and take to every single strategy that you have. You have more risk if you just buy a call, because instead of let's say for instance that you purchase this call, buy to open, and you spent $500. But then over here, when you sell to open, you actually collected $300. So we put this negative because you collected that. So now you actually, instead of it cost you $500, it only costs you $200 total. So the give and take is that instead of having a $500 risk, now you only have a $200 risk, but you have a max profit because the call that you bought can only come up to here, and then it's going to stop gaining profit, if that makes sense. So let's keep going. We can even take it and we can do something like an iron condor. Now, iron condor, if you look, you can see that you have a range that the stock can stay in. If it goes above this range or goes below this range, then you begin to lose money. But if it stays within this range right here, you can make your max profit. You actually kind of see even right here where it tapers off. You start losing money here and you start losing money here as the stock begins to move up or down. And so, like I said before, we have the ability to create complex strategies. I alluded to it being like trigonometry or geometry in one of my first lessons. But as you see, we can begin to actually really make this do some wonderful things. Or we can have our risk reward be unlimited, or we can have our risk reward be limited. And so that way we know what we are potentially risking or potentially making at the same time. All right. So what we're looking at here is the actual risk reward graph.
inside of my platform, and the platform I use is Tasty Trade. And so you'll see that you actually have the price of the stock. The stock goes up, you will make or lose money depending on which strategy you deployed. And as the stock goes down, you will make or lose money depending on how the strategy was deployed. So let's look at this. And so let's go ahead and put a position on. We're going to go to the table and actually pick a position. So I want to show you guys one thing too. Remember I said that you could have um, stock options that expire in 6 days, 13 days, 20 days, even up to a couple years. If you look at this, this is actually 825 days. And so that's about 2.5 years. So we're going to go 30 days out. We're going to go to November 21st. And here's all your strike prices. So this is the price that you're saying, hey, this is my line in the sand. I want to get above this price. And so for 30 days, to buy the 250 strike price is going to cost you $10.75, which is $1,075. So even tells you your max loss is $1,075. So let's go back to the graph and let's actually look at this and see if we can analyze this and see how this all works. You see right here, you have the line that says, hey, your max loss. And this is all based off of expiration. So if at expiration the stock is still at 250, you will see you actually only lose, instead of losing the whole 1,075, you actually still have $248 of profit that you can get back of your money that you actually spent. So I do want to show you guys one thing. Whereas in the graph that I created for you, had the profit and loss on the X, Y axis, you would see negative 100, or excuse me, positive 100, 200, 300, 400, and then negative 100, negative 200. Over here, instead of seeing that, you actually see it over here. So as you move the price, as the price moves up, you can see how much you'll make. And this is based off of at expiration, right? So you really need to get to about 200. Let's see if we can zoom in a little bit on this. You need the stock to get to about $262 just to break even, because you spent that amount of money. So in order to actually get that money back, you need to, the option will have that value. And so you need for it to go back. If the stock price goes down, then you can see that you are actually losing money. And once you get below this price at expiration, then you just have a max loss. The most you can lose is $10.75. So I hope that makes sense, right? So we definitely want the stock to move up in value. But as you can see, you actually have unlimited profit potential if the stock keeps moving up in value. Now we know the stock won't just go to infinity, but this is how much you can actually make. And so this is how a risk reward graph looks. And so you can see your max loss, your max profit, and you can even look at stuff based off of time. Well, I will get into that in a later video. We don't want to get too in the weeds today. So let's go look at a different risk reward graph so we can see the long call. Basically, as the stock goes up in price, the stock option gains value. But let's look at, let's say maybe an iron condor. So we're going to go back and we're going to change this out. Let's clear this. And so for iron condor, we want to stay inside of a range. So we want to stay under 270. And then we want to stay, let's say, above 230. And so when we do that, if we go back to the table, the graph, now you can see, now you have this whole big area that the stock can stay in. And as long as it stays within this area, you will still make money. You see how it's flat all the way around. You have max profit. So your max profit is $156. Your max loss is $344. And so you can see, as long as it stays within this range, your P&L stays at the 2. It doesn't change at all. And then as it starts to go out, that's when you begin to lose money. Okay? And you still even have a max loss. If you come down here and look, you see how this flattens out because you have a max loss. So whereas some of the strategies that we talk about have unlimited loss or unlimited risk, this strategy has a limited risk. And so it's able to show you a visual representation of how the stock option that you are purchasing or selling will affect your account value based off of the movement of the stock. So I hope that all makes sense, and we will try and dive further into it as we get into deeper and deeper lessons.